We have not met. My name is Bronson Hill. I'm the CEO of Bronson Equity. We do these events once a month because there's a lot to talk about. There's always a lot to talk about. And this event, Be Greedy When Others Are Fearful, really comes from the Warren Buffett quote of, be fearful when others are greedy and be greedy when others are fearful. And there's a lot of fear right now in the market. There's a lot of people say, oh, I don't know what to do, or maybe I've had a deal that didn't go as well, or I'm not finding, I just don't know what to do right now. And so there's a lot of opportunity there to be able to find new opportunities. So I'm going to go ahead and welcome our guests up here. Go ahead and keep that chat going if you like. Looks like we got Billings, Montana. Love it. We got Brad. We got Peter from NYC. And we got Huntington, West Virginia, San Diego. We got people from all over. So go ahead and keep that going there as well. And we'll go ahead and welcome the our guest panelists. We have an awesome panel today. Super excited. So welcome up them here. If I can figure out how to get them all up here. Here we go. Okay, awesome. All right, so as they're coming up here, I'm going to give a quick intro to each of our guests. You can change your view if you're watching this on your mobile device or on your computer. So you can change it by just changing the view if you want to see everybody at the same time, or change it up and see them individually. First of all, introduce Joe Brown from Heresy Financial. He does a lot in macroeconomics. Really excited to have him here today. So welcome, Joe. Good to have you.
Thanks for having me.
Awesome. We also have Rod Kleif from the Lifetime Cash Flow Academy, and big multifamily investor and mindset guy. I call him the Tony Robbins of multifamily investing. So welcome, Rod. How you doing?
Good, brother. Thanks for having me here. We'll have fun tonight.
Good to see you. I feel just even from your background there that I'm just like, are you actually on your patio right now? It looks like I'm
yeah, it's a green screen, but it is my backyard.
Yeah. Okay. That's awesome. That's awesome. And then we have Ryan Gibson coming in from sunny Seattle, and he's with Spartan Investment Group, does self-storage. Ryan, how you doing?
Good. How are you? Thanks for having me.
Good. So good to have you. And I know we were in Seattle a little while ago sharing a meal. It was great to be up there in my hometown. So good to have you in there. So we've got a great panel today. So really what we're going to do today for our audience, we're going to basically get into what's happening right now. And again, it's important, opportunity and risks are really two, sides of the same coin, right? So everything we talk about, we want to make sure that we're looking at what opportunities are there and also examining what the risks are. Because as an investor, if I've got money just sitting in the bank or under a mattress, I could be putting in an investment. I could be waiting for, the right opportunity. And it's important to really be paying attention to that. So let's talk about that for a minute. Let's start with Joe Brown. Joe, why don't you talk to us a little bit about mainstream media and why it's so hard to actually get good information as an investor and be able to make good decisions? And what are some ways that you can help educate yourself in making better investment decisions?
Yeah, absolutely. One of the reasons why I think it's difficult to find actionable investment information from the mainstream media is because there are so many filters that information has to go through before it gets to you, that number one, there's a delay of time. And then number two, there's an actual filter of information. So by the time you're seeing something, it is mostly signal, but it's processed and priced in already. So like the closer you can get your ear to the ground, especially if you're in, a more specific and focused niche or industry, the closer you can get to the ground, the more you're going to be able to see stuff before it actually gets priced in. You'll notice trends popping up sooner. The hard part is you're going to see a lot more noise rather than, purely signal. But it just takes practice. So like, kind of an extreme example of this is there were quite a few videos in November and December of 2019 coming out of China of people like falling over, collapsing. And once the novel virus was confirmed in another country, there were quite a few people in like December of 2019 that were saying, hey, this is potentially going to be something that is a big deal. Versus most of the world, mainstream media started, they realized something was happening probably end of February 2020 when the market started to collapse. And so that was one example of, there were quite a few people, myself included, positioning for a big market crash for that. Like Ray Dalio is another one. He bought a bunch of puts in for March of 2020, and he did that trade at the end of 2019. So you do have to sift through a bunch more noise to find the signal, but keeping your ear closer to the ground from unofficial sources where it's just mainly people and individuals talking about the things, and paying attention to that, you start to notice what the signal is yourself.
Right. And I think that's, information is definitely one part of it. Another part I find is in a time where there's economic uncertainty, which just about any time has that, but especially now when things are kind of mixed, we see investors, one pitfall is, people will just avoid getting in, or they'll say, oh, I'll wait and I'll kind of do something later, or I'll do something here, or they'll make a spur of the moment decision. Rod, can you talk a little bit about just some other pitfalls or some of the ways that impacts investors when it's a time of recession or some sort of economic recovery?
Well, I got to tell you, it's mindset, and I mean, you see it in stock market trading. I mean, Joe, I'm sure you see it. By the way, great explanation on the noise. Now, I for those of you who don't know me, I lost $50 million in 2008 and 9, so I got my ass handed to me, and obviously there was a lot of fear, but I think I'm going to speak a little bit out there in woo-woo land here for a second, but things that I teach around mindset are, get around people that aren't in fear. Number one, pay attention to what you're focused on, because what you focus on gets larger, positive or negative. And I mean, I got myself sucked into the crap on the news, and which is mostly crap at this point, propaganda and censored information. And so, I love what you said, Joe, where you hear it from people, actually from people rather than from the news organizations. And so, but a lot of investors hide their head in the sand when there's incredible opportunity, which there is right now. I mean, we just got a screaming deal under contract. I mean, I won't sell it, but I mean, we're paying $100,000 a door. The one next door sold for $137,000 a door. So we're getting like a 40% discount right now on a deal we have under contract in San Antonio. So deals are coming. There's still some delta between what sellers think they can get, and there's still some sellers holding on. But I'm very bearish right now. I think the proverbial what's going to hit the fan. There's a lot of debt coming due, and there's a lot of opportunity coming. But if you're an investor and you're caught up in fear or you're in trepidation, man, this is the time you want to get into cash and be ready to capitalize on what's coming, not get sucked into the fear. So long answer to your question.
It really is the idea too that the time of maximum pessimism is the greatest time to invest, but it's biologically we're geared to say, oh no, there's fear, we got to go the other way. But you said not staying in fear.
Warren Buffett's quote, I pulled it out as the headline for this thing: be fearful when others are greedy. And there's been a lot of greed the last few years, but be greedy when others are fearful. Right now people are fearful. Get greedy. Capitalize on what's happening. So, because it's coming, and I think there's going to be opportunity everywhere in businesses to buy businesses. There's a ton of baby boomers retiring. It's like a silver tsunami, and of course real estate. And I mean, we won't even talk about office, but certainly in multifamily, which is my what I teach. There's a lot of people with bridge debt coming due, and myself included. I got a couple deals. We got to scrape some money together for rate caps. Makes me frustrated, but there's a lot of people that don't have the ability to scrape that money together. So I think there's a lot of money sitting on the sidelines to capitalize on this. And if you're listening and if you've got a lot of trepidation, you've got to be careful, but don't stall out and don't get caught up in fear, because you're going to miss opportunity for sure.
Yeah, it's easy to get stuck there. And that's where a lot of investors I found, talked to over 2,000 investors one-on-one on calls, and a lot of high net worth folks, and a lot of people, a lot of retail people slow down when family offices and larger groups are just picking up stuff like crazy right now. Yeah. Ryan, let's talk about, you have kind of a unique niche in self-storage. You've got a huge, $1 billion worth of self-storage. You guys are developing as well. Talk to us about self-storage and some of the opportunities you're seeing there, and maybe some of the risks. And I know there's a difference between buying existing and building. Maybe you can kind of touch on both of those.
Yeah, I would say, first of all, I'd agree with what Rod and Joe were talking about with, and just add on to it that market fundamentals are what are going to be consistent, right? So you're still going to look for population growth, job growth. You're still looking for good income, good demographics. That all still exists. Those markets are still there to find. The major difference now is you can go into those markets and find expiring debt on an asset and really take advantage of getting something at a low basis, which is exactly what we've been doing over the past year. I would say when you look at ground up development versus value add existing properties. To Rod's point, the bid ask on some of these assets is still out of whack. Sellers still think their property is worth X and it's really worth Y. And so you've got to go in and you've got to negotiate a good price. But when you build from the ground up, you can build for less than the cost to buy still and kind of bake in some risk mitigation. So what I mean by that is, a yield on cost is really a metric that you want to think about. And if you don't know what that is, you can look it up. But basically, it's your going in cap rate on your total cost of building an asset, right? So if you buy a self-storage property right now, you're probably looking 6 to 7% cap rate going in, depending on the quality and the market and all that stuff, right? But if you build one, you can still build a double-digit yield on cost. You can still find markets where rents are strong and the basis of the land is low. And if you can build for $80 to $90 a square foot, like you can some of the single story self-storage, you can find yield on cost at 10 to 11%. And when you can build at a 10 to 11% yield on cost, you've got market movement buffered built in so that, by the time you deliver the stabilized asset, you're coming in at a higher double-digit cap rate. Meanwhile, if interest rates stay up and stay up for longer, no big deal. You can make that spread work on an 8 or 7% interest rate, right? But if the rates come down, it's just all gravy on top at that point, right? So we've been building like crazy. We have 10 sites that we have in the various phases of construction. We're building all the way from the Pacific Northwest all the way down to Florida and everywhere in between. And, our construction crews are running at full steam, entitling and permitting these sites. And we're seeing a lot of value. And that's actually where we've put a lot of our focus is these underserved markets that have a ton of demand. The demographics are super strong. And we're getting a basis on these properties. That's great. And the best thing about buying raw land, and I know that maybe a lot of listeners have bought raw land. It's something that not a lot of people want, right? So if you call, someone selling vacant land, it's usually a really friendly conversation versus buying a value add existing property right now, where, let's face it, there's not a lot of inventory, right? There's not a ton of self-storage listings. So people think, oh, it's a great time to buy because you're going to get a discount. It's actually a terrible time to buy from a competitive standpoint because there's fewer listings, and those listings are getting bid on by a lot of people right now. And so it's actually, the competition is quite fierce for high quality products. So I would say that's the other advantage of that. And the only other thing I wanted to add is, if you're a speculator, you're going to wait for the perfect time, right? And you're gonna roll and gamble with the market and interest rates. If you're an investor, you're accustomed to investing in all points of the cycle. So really, you want to take the emotion out of it and not be afraid to buy low, because this is the time to do it. So just got to know those niches and those markets, and a lot of good stuff on the horizon.
So something you shared is really true. And again, we have a special guest. It's actually Mr. Warren Buffett himself. I wish he was actually going to be here, but his quote is going to be here. So the idea that like a margin of safety, right? You talked about getting a margin of safety, which is a huge thing. If you can get something, buying $1 for 40 cents or buying stuff when it's on sale, or the yield to cost metric that you mentioned. So we're going to get into risks in a little bit, but I want to get into kind of right in the nitty gritty here, kind of on the vein you're talking about. What are the current opportunities that you're seeing right now personally, that you're like, and again, as an investor, I know some of us are asset specific. I try to look at, all different things. We're doing businesses and ATMs and car washes and multifamily and senior housing development, all kinds of things. But Joe, talk to us a little bit. I know you're a little bit more that way too, from a macro view. What are you seeing as some of the opportunities that are available now that are out there as far as for investors?
Yeah, absolutely. So some of the opportunities, the way that I mostly filter is through macroeconomics. And so I'm kind of taking a top-down approach. And specifically with real estate, there are not a lot of factors at play, or that could be at play anytime soon, that I view as bearish for single-family homes. The things that could cause, another, financial crisis, another, great recession, another 2008, 2009, they either don't exist right now, or we have, a pretty good idea that they wouldn't be allowed to happen. So number one, a massive nationwide apocalypse of everybody losing their jobs. That would probably cause some severe, quick deflation and defaults that would be rescued by a swift money printing slash rates lowering, which is going to drive real estate back higher. We don't have the nationwide, everybody has, 2, 3 homes with adjustable rate mortgage on them that are all having their rates adjusted up anytime soon. Pretty much most single family homes right now, 60% of them are owned outright, no debt. The ones that do have debt, something like 90% of them have a interest rate that is fixed interest rate, 30-year lower than 5%. So all those people who bought a home, they're all locked in right now. There are very few homeowners who are looking at, selling and being able to buy something similar for a similar monthly cost. So a lot of homeowners are locked in right now. And rates lowering are going to allow a lot of millennials who have been waiting for the crash since 2012. They're still sitting on the sidelines. A lowering of rates is going to bring a bunch of new buyers in. And then it goes back to demographics as well. Like mentioned earlier, that there's, an increase in population, whether it's from the birth rate or from new people coming to live here from other countries. And that is continuing to happen all over the place, and more people who need more places to live, and they're not being built as fast as we're getting a population increase. And so until some of those factors change, single family homes specifically, and also multifamily as well. We've got, some strong bullish forces for a long time. It's I think a little bit harder to find unless you're on the ground. If you're a passive investor, a little bit more like me, if you're not on the ground, going door to door, if you're not in the market, in the neighborhood, like it's a little bit harder to find deals as easily as it was, let's say 5 years ago. But on the other hand, you can also be a lender with these high rates. Like, for the last couple of years, it's been really easy to lend at 10 to 15% hard. So if you don't like to, purchase the asset, you can always take advantage of the high rates right now and be on the other side. That's still a decent return.
Yeah, it's actually what we're into. We're doing a debt fund that's 7 to 15% that we're getting to investors, and it's people it being on the equity side at low leverage, 50% loan to value is a much safer place for a lot of folks that are like, I don't know if I want to do multifamily because of.
Yeah.
I talked to one investor that was in like 5 capital calls, and yet that's also a sign too that there is opportunity coming. So, Rod, I know you're a multifamily guy. I know we've had some multifamily challenges, particularly in some of the value add stuff or bridge debt. Can you talk to us a little bit about the landscape of multifamily and some of the opportunities and challenges that are there, and just some of the stuff that you're seeing on the ground?
Well, yeah, no, I mean, as I said, I feel like it's opening up. We've got a screaming deal under contract right now, and we're seeing operators that are really struggling, and some of them are going to foreclosure. We've seen some foreclosures in Texas, some big ones, and my SEC attorney that does all my SEC work says 90% of his practice right now is working with lenders and forbearance and loan modifications and foreclosures and capital calls. And so, he's shifted his whole practice over to helping people that are in trouble. And so, I'll tell you, luckily now the lenders are being flexible. And so they are working with borrowers to some extent. If that continues, then maybe it'll be a soft landing. If it doesn't, I think we're going to see some serious pain. I agree with Joe about single families. There's a huge pent up demand. There's a huge housing shortage. We won't even talk about whatever it is, 11 million, 17 million people that have crossed the border. We had a shortage before that happened. And so, who knows how it's all going to shake out now. But on the commercial side, I mean, you look at office. I saw a headline today about office, how, they've been, businesses have been paying their rent, but when those leases come due, I mean, there's places that are 50, 60, 70% occupied. And I mean, these assets don't break even unless they're in the 80s minimum. And so, we're talking about a catalyst, and I don't want to scare people, but I believe in opportunity, but I think, if a lot of that debt is held by small and regional banks, and, if that, what hits the fan, we're going to see some bank failures. Like, we've got a fund as well, but I've got it in, it's paying, I don't know, 4 or 5% interest, but it spreads out over 80 banks, and nobody goes above the 250K FDIC limit at any of the banks. So it's spread like that. So it's a very protected fund for people to put money into. But I will tell you, these people that have bridge debt, and there's a ton of it coming due. They either have to sell or they have to refinance. Sales right now are down 90%. Sales are not selling like they did. Refinancing, you've got to do a rate cap. And I'll give you an example of what's happened with rate caps. Back in 2020, you could get $100 million rate cap for 3 years, 3%. So the rate's not going to go up more than 3% for 3 years. It was $23,000. Now, this headline is from a year ago, so it's more than this now. But a 1-year extension on 100 million back then, when this came out a year ago, was 2.3 million. Okay, so it's more than that now. So the point is, it's very, very difficult, and these properties aren't meeting debt service coverage requirements, so money has to go in. So again, I'm not trying to scare anybody on this call. I'm trying to get you excited, because I think there's going to be some freaking opportunity and to buy distressed assets like the one we've got under contract right now. And so, I'm gearing up. I'm in a lot of cash. I'm telling my peeps, my students, I've got about 1,500 students, to get in cash, and with crisis comes opportunity, and cash is king in a crisis. So I'm wrong all the time. I could be wrong on this. My kids love to tell me, you're tired of being wrong, but who knows how it'll all shake out. But I went through 08 and 09. I got my ass handed to me, and I got crushed by that wave. If this wave comes, I'm surfing it. That's all I can tell you.
Yeah, no, that's a really great point, Rod. I mean, and I think I'd love to hear from the rest of the panel as well. There's this question I love asking on this panel is like, are you fully in cash, or are you investing at all? I tend to be kind of an invest at all kind of most of the time guy, just to kind of get the money working. But there are times where having lots of cash is great. And if you're the one that has cash, you're going to clean up and do super well. Ryan, how do you fall personally on that kind of spectrum? I always like getting people's personal opinion based on what they're doing, not just in their business, but personally from an investment standpoint. Are you mostly personally in cash? Are you mostly invested, or how are you diversified there?
Yeah, pretty well diversified across multifamily, self-storage, development, debt funds, a lot of private debt. I'm invested in tons of private credit. I would say majority of my portfolio is in that. But I'm a real estate developer, so I have to stay liquid. So liquidity is high, for loans and for guarantees and things like that. So I would say that I'm always in cash. I'd say it's a good time to be in, it's not so bad to be in cash right now. You're not going to beat inflation with a savings account, but it's better than zero, which is what it was for a long time, obviously. But I did want to kind of piggyback on this whole aspect of the market not moving. Like, people aren't buying and selling homes, and people aren't moving. So when you think about self-storage, 30% of our customers are moves, right? So that's when people buy or sell a house, they move, they downsize, they displace, they get a new job in a new market, and they leave. There was an article in the Wall Street Journal about a month ago that said people are getting divorced and not even moving out of their house because it's so expensive to get rent somewhere for an apartment or to buy a house, right? So like, when you think about like the 4 Ds of self-storage, are death, displacement, downsizing, and divorce, right? Those are what drive our customer base to our property. So when you think about storage, like, storage is a pretty recession resilient, for the last 40 years, it's pretty good. When you look at this market, self-storage customer acquire, to acquire a customer right now, it's become incredibly difficult. We've had to give away promotions, and we've had to, discount units and fight for occupancy. And so the biggest operator out there is Extra Space. And what they did was they lowered their asking rents significantly to sort of grab market share. Now, if anybody's listening who has a self-storage facility, they probably know what I'm going to say next, which is, yes, I got that great discount, but what happened right at 4 months or 5 months when I moved into the property? Wham, got my rate increased substantially. I literally have a text message from an investor yesterday that said, is there a limit to how much they can raise my rents in my storage unit? And I wrote back with a sad face and a smiley face, no, there's no limit. So what's happening in this market is, a customer acquisition is tough, but REITs and the storage operators are raising their rents sooner and more aggressively, which actually has led to 4% industry-wide year-over-year rent growth. So we're actually seeing revenue growth year-over-year in the storage sector. And this is without 30% of our customers even in the game, right? Because if you don't buy and sell a house, you don't move. If you get divorced and you don't move out, guess what? There's no storage. And that's when people typically use a self-storage. So I see this massive pent-up demand. And whether you're in storage or thinking about it, or you're in single family or thinking about it, or in a moving company, whatever you're doing, I see this huge pent up demand happening for moving. Right. And I see it with my friends, right? There's some friends in the neighborhood that want to buy and move out, but nothing's for sale. There's nothing for sale in the market, right? Anything that sells actually trades pretty fast. So it's a very like I think everybody's sort of waiting, and this happened in COVID, right? Remember 2020, everybody like did nothing for a year, and then in 2021, that spring it went nuts. Everybody was moving everywhere and buying, and there was lines for open houses for homes. I think that's coming. So whatever you're in, I would just be ready for that. Whatever that means for you as an investor, get ready for that. For our standpoint, what we've done with that information is said, hey, let's continue to buy in good markets that have really good demand. And by the way, rents are down. So it's really hard to price a property, but we know rents have not declined. So what we can do is we can kind of assume where rents are, and with our data and our aggregation, we can build for less than we can buy. And what we know is that when the spigot turns back on and people start moving again, and they will at some point, right? That we're going to have this huge surge in demand for moves and for lease up. And the last thing is it's difficult to build right now because it's hard to get financing. So if you talk to a construction lender, rates are 8+%. A lot of lenders are only doing floating, and everybody that rings the bell now in everybody's minds. They, I don't want a floating rate loan. I want a fixed rate loan. And there's very few people lending on a fixed rate loan. And so the number of construction permits that are getting vacated or abandoned, people are bailing on their projects. So what that's doing, it's lowering the supply of inventory of storage going to the market. And in this high interest rate environment, while pent up demand surges, I think we're going to have an explosion when rates fall. And I'm not saying rates are going to fall this year or next year. I don't want to get into that. Ray Dalio, he who has the crystal ball, like, eats shattered glass, right? Like, I don't ever want to predict when interest rates are going to go down. But if they do, and people start moving, or if there's some change in the market that helps these movings happen, we're going to see a huge surge in demand for multiple different things.
So Ryan, I've got a whole new demographic for you with those divorcees that are still at home. You could just open it up and say, bring a couch and move into my storage unit, right? You got a whole
Well, they're probably already doing it. So
yeah. yeah. They don't understand where occupancy went way up, but there's all these people living here, all these cars.
Yeah, exactly.
Thanks for sharing that. A lot of great points there. Joe, talk to us a little bit about what you're seeing and kind of how you're investing. Are you mostly cash? Are you deployed? How are you kind of spreading things around right now?
Yeah, great question. So three things. Number one, markets die, not of old age, but of euphoria. And so there's whenever be greedy when others are fearful. There's a lot of fear in some of these markets right now. That is a very good sign that it's hard to get in. People are fearful of it. They think it's going to crash. They think it's going to go, start burning down. That's a time to start getting in. It doesn't mean you're not going to experience pain, but it means over the long term, you're probably getting in at a right time. Euphoria is not like, even like we look at like 2021, like in single family house, that wasn't euphoria. Nobody was buying homes in 2021 because they thought they were going to be wealthy and be able to retire and, live on a beach. They're buying homes because they were saying, prices are running away from me. I got to get in now or else I might not ever be able to buy a house. That's not euphoria. Euphoria is like, what happened with Bitcoin when it hit 65,000 and, all the NFTs. It's like everybody is, buying Lamborghinis and Rolexes and thinking they were going to live on the beach. And, that's euphoria that's going to crash. And we have not seen that in real estate. In terms of my portfolio, I usually like to stick to around 30% cash. And I know sometimes that seems pretty high, to others that seems low. 30%, and that's not like, just, physical cash, just not like cash in a checking account. Things like T-bills, money market funds, even gold I include in there. It's just reserves. It's savings. It's what I can fall on if I need to, if assets are, there's fire sales on assets. So I don't have to be able to be one of those people liquidating at the bottom just so I can, make ends meet. So that I can hold through the tough times, but also so I can use that to buy assets when they are on sale. Because if everything crashes and I have that cash allocation, now I can rebalance basically, and I can buy those assets. And now I stick to around 30% allocation. But it's because I was able to move some cash into those assets that are now on sale. And cash, for the first time in many years has above a 0 or 1% rate of return. So you're not exactly sitting on something that is just burning up in front of your eyes right now, especially if you're in T-bills or even gold, which will appreciate over time. So
Right.
I usually try and stick to about a 30%. I'm probably a little bit more than that right now. But looking for deals to close on. So usually trying to stick around that 30% mark, and over long term, as you rebalance, you're using that to deploy into assets, or you're selling assets to fill up that cash buffer.
Yeah, that's great. No, I think it's great to have some diversity and be in different assets as well as be concentrated. I actually do a fair amount in precious metals, have some gold and silver. I also love cash flowing assets that I just feel like reduce my basis over time and the longer I hold them, which is great. And then having some available for the future. We're going to get into some questions here in a minute, so we're not quite ready to get the chat going yet or the Q&A section going, but I want to ask the panelists one or two more questions. Let's talk, Rod. What do you see? Obviously, one side is opportunity, and the other side is risks. And I want you to speak from both a mindset perspective as well as an actual investment perspective. What do you see the biggest risks are for an investor right now? Obviously, there's a risk of not doing anything and missing it, but what are some other risks? Is it getting into deals that have the wrong kind of debt? Is it just
That's it.
inaction? Yeah.
Yeah, that's it. I mean, you said it right there. I was just going to reply with that answer.
Yeah.
You need to, if you're going to invest in somebody's deal, I've got an incredible resource. I'll throw it out there. It's called the Cash Flow Club. If you go to Cree Capital, CREE capital.com, you go to this Cash Flow Club, there's tons of resources there, tons of articles I've written, videos, books, and things like that. And it's free, and I don't try to sell you anything. Don't worry about that. But that we just did a webinar about that, about the impact of debt on a deal. And that's the reason I brought it up and thought about it. And, if you're going to invest in somebody's syndication or somebody's deal, you better find out what kind of debt they have and what their plan is for that debt. There's a reason a lot of operators are in trouble right now, because they use bridge debt, which was, bridge debt is supposed to bridge the gap from a non-performing asset to a performing asset. The problem is, and then you get conforming debt, which is Fannie Mae and Freddie Mac, non-recourse debt. That's typically that's what bridge debt was put in place for. Well, when Fannie Mae and Freddie Mac started lowering their loan to value ratio, people were using bridge debt just to be able to show higher returns for their investors, thinking that this gravy train was going to last forever and these rates weren't going to change. And so that's why, a lot of operators have gotten themselves in a pickle with that type of debt. And so, just pay attention to the debt. Also pay attention to the operator. What's their background? Have they gone full cycle on some deals, meaning bought and sold and turned a profit? Do your homework. When you go to the Cree Cash Flow Club, go to the book section. There's a book called The Questions You Should Ask a GP Investor Before You Invest in a syndication. There's a whole bunch of questions. Get that, read it. There's a ton of other books there as well. You just got to do your homework. That's all. Don't be lazy. Don't be lazy, because, you see people, they'll invest in the stock market with a broker, and the broker has been trained in one thing really well, which is sales, or they'll invest with an operator that's brand new, that's got a flashy, beautiful website, but they don't do any background to check them out. And so just do some homework, do a little legwork. And again, go to the Cash Flow Club at that crecapital.com, CREEcapital.com, and educate yourself a little bit. You spend a couple, 3 hours there, and you'll be ahead of damn near anybody that invests passively in a syndication, but
Great.
yeah. So.
Yeah. Thanks, Rod. Appreciate that, man. Ryan, what are some risks that you're seeing out there? Anything you want to add to what Rod shared?
Private credit, private debt, direct lending, debt funds, right? All the same terms in their own way. This is like a popular thing, right? Everybody's doing a debt fund now. Everybody's doing private credit now. Everybody's doing direct lending now. Those are not all created equal. Like, you've got to understand how these funds work. So, I think what's happening is cap rates are still compressed, interest rates are really high, and so what's happened is all the cash flow is dried up, right? So if you're trying to buy a multifamily, self-storage, or any type of hard asset, the reality is you're going to pay a low cap rate still, and you have what's called negative leverage, right? So you've got this high interest rate and you've got this low cap rate. So what's happened is it's very difficult to buy real estate and put a good interest rate or a good cash flow in front of you, right? Remember back in 2021 when everybody we were all heroes, right? Because we could buy something for, you know, a cap rate of 5 or 6% and put 3.5, 3% debt on it. We could make a spread just on the debt. We could make cash flow just on the debt, right? And so an investor would come to us and say, "Hey, I want to invest in your deal," and we'd have cash flow for them because the debt was low, the cap rate was high, right? And if you put that money in your bank account, you'd make nothing. Now it's flip-flopped, right? Now you can put your money in your bank account, you can make cash flow, and if you put it into an equity deal that has real estate, you're probably not going to cash flow. So what has everybody done? They were like, "Wow, it's really hard to raise money." Well, duh, because there's no cash flow, right? And like we're not all heroes here. There's not a magician. If you're making something cash flow right now, you're either buying an extremely tertiary market, a low quality asset, or you're just a bad projector, right? I mean, at the end of the day, it's really hard to find stuff that cash flows. So this flock to private debt, this flock to private credit or direct lending has happened, and everybody is offering it, and they're not all created equal. And I could go on a complete tangent about that, right? Because at the end of the day, how is it collateralized? Are they getting a first lien position? Is there a personal guarantee behind it? How liquid is the borrower? What is the borrower's personal financial statement? What is the borrower's credit history? Where are you landing in the capital stack? Are you pref equity? Are you second position, first position, third position? Are you no position? What is the history of the borrower in paying off the notes? You know, there might be some really high interest rates flashed on your Facebook feed and an ad, but what is it? What's behind that debt, and where are you crunching into the asset? So, you know, my risk is, you know, what I see is like everybody's into a debt fund now. We've been doing debt funds since 2016, right? And now all of a sudden it's this big thing, right? Because it's hard to, you know, it's hard to find cash flow. So I tell investors, and some operators are saying, "Oh, we're going to mix debt in with equity and try to make this amalgamatized fund that gives everything that you think you want, but it's gonna lend out to houses. It's gonna do this asset class, that's right." Like it's like, whoa, you know, just be careful of how these things are structured, and be careful about what that note is backed by. And guys, you know, I don't really have one source to go to or one book to read. Just know that, you know, there's a lot of things that are circulating out there that might not be created equal. So be careful about the interest rate that you chase, because that's something that's going to be really popular over the next 12 months as people scramble to bring in debt because they can't refinance, or there's bridge debt to all the things that Rod was talking about.
And that went south really quickly in 08 and 9, by the way. This private debt, same thing happened where a lot of those operators or a lot of those people that had that private debt got in trouble because, you know, they didn't pay attention to all those fundamentals you just mentioned, Ryan. So that's a really good point.
Yeah, it's really important to understand, you know, what you have. And I think in my book, I talk about this, about analyzing any deal. There's usually, you know, one way you're looking, you know, how would you make money on this? And what's the primary one or two risks of how you could lose money? And a big thing on debt funds particularly is where are you at in the stack? And what do you know, what are the risks involved with that? Because there's a lot of things that could happen that if you don't really understand how that's going, you know, if something goes wrong, what happens there? Joe, talk to us about how you're perceiving risk right now in the market, and some things to be aware of as an investor.
Yeah, I've taken some notes as Rod and Ryan were talking there. I think the number one thing is like, even from a personal standpoint, like you can have good assets, but personally, if you're leveraged to the hilt and, you know, leveraged up to your eyeballs, that's risk, and you could be forced to do things that you don't want to do if tough times hit. So I'd say like the number one thing right now is to deleverage, and a good rule of thumb is like, just, you know, across the board is don't carry debt that is above the rate of inflation. Like I think there's, on the other hand, there's a lot of people right now that like I've interacted with that are talking about trying to pay off their mortgage on their primary residence, and they have like an under 3% mortgage. I think that's like, you know, to the extreme, like a bad move. Like just the math is just like crazy to do that. Put it in a money market fund, and you're going to be making 2% for free. So But I would say that there's a significant percentage of the population right now that is leveraged up to their eyeballs. We're seeing household debt rates, we're seeing credit card rates, we're seeing everything just it keeps on climbing. And you don't want to be in that position when it hits the fan and you're forced to liquidate assets at fire sale prices because you couldn't manage your own personal your home budget. So definitely deleverage. Don't carry any debt over the rate of inflation. Definitely don't carry any variable rate, adjustable rate debt. And then the last thing, and I think this is a big risk right now, maybe always, that people are always looking for a way to do things passively, and I don't think that I think the term passive investment is an oxymoron. Like it does, if you're investing, like truly investing, you're not doing it passively. In order to be investing, you are active in some fashion. And that there's an old proverb that says, "Look well into your investments." Thousands of years old. Basically, like don't the time tested wisdom of don't put your money in something that you haven't spent the time researching and having a really good confidence that it's going to produce a return for you. And the less you do of that work ahead of time, the more you're gambling. And so people who think they're passive investing are usually just gambling. They're throwing money in a passive index fund, throwing it in the stock market because somebody who's paid to tell them this tells them, hey, as long as you just keep on throwing money at this paper machine, it's going to keep on going up and eventually you'll have enough to retire. And it's like, well, do you know what you're investing in? Do you know how these companies are coming up with their profits? Do you know how these valuations are arrived at right now? Do you know what you're purchasing? And for 99% of people, the answer is no. So you're not investing, you're gambling. And so no matter what you're investing in, real estate or stocks or private businesses or debt, you've got to do the research. You've got to put the legwork in. You've got to look well into your investments. Otherwise, you're just rolling the dice.
Exactly. No, yeah, exactly. You got to know what you're getting into, and sometimes even Warren Buffett says we don't invest in anything we don't understand. And so I quote the guy a lot, but he's been uber successful. We're going to start taking some Q&A now. So I know you have some questions. So in the Q&A section, just start putting some questions in there. I'm going to share real quick a couple quick announcements about our event next month, as well as something else. So this is our event. This is a physician real estate roundtable. You don't have to be a physician to attend this, but if you're a professional, if you're a business owner, a lot of things are going to relate to you. Tax savings, real estate investing. These guys, Buck Joffrey has raised over $700 million from different investors. I think Tom Burns has raised at least 100 million. Vikram Raya, kind of similar to that. So it's going to be a great conversation, April 16th. So I'll go ahead and put that in the chat here in a minute. And then also we have speaking of debt funds, we do have a recessionary income fund, which is producing between 7 and 15%. First position notes, 50% loan to value. We're originating these notes, a variety of commercial real estate assets. It's very compelling, especially if you only need like something short term. There's something you can get a better return than you're getting in your bank or somewhere else. So you can shoot me an email about that if you are interested. We will get into Q&A here in a minute, and I will stick that into the chat. So we'll stop sharing there. I'll stick the next event coming up there. You can register for that right now. It looks like we have no questions so far. So you guys have answered everything. I got to say, this is a great conversation.
Our work here is done, man. Our work here is done.
Yeah, exactly. But no, I love the conversation around just all of this because it's, when investing comes down to risks and opportunities, right? Understanding what your risks are, understanding, if this doesn't go well, there's actually a book I love called The Dondo Investor. It's Manish Prabhai, and he says like heads I win and tails I don't lose much. And it's that kind of idea of asymmetric returns, right? So maybe, there's a high upside but the downside is not that low, or you look at it comparatively. Are there any tools that, just as we're waiting for some questions to come in, are there any tools or books that have impacted you significantly that you're like, I think everybody should read this book, or I think everybody should get into this? And of course, it could be your own. Well, we know it'd be your own book and your own YouTube and you guys have wildly successful stuff you're putting out there. But is there something that maybe when you were learning about investing going back, 10, 20 years ago, something you're like, I just think everybody should read this?
My books are all on mindset, so I can throw mine out there.
Please do.
My love language is gifts. If you haven't read the 5 love languages, I was blessed to have the author on my podcast. But the gifts I give my students include the slight edge, about those little
good one.
decisions you make every day that traject your life up or down. They don't mean much that day, but they propel you I've given away, I'm not exaggerating, I think close to 5,000 copies of Think and Grow Rich. If you haven't read
Yeah,
that,
it's
you're
a great one
crazy.
too.
That's one you read several times a year. Um, of course, Gary Keller's One Thing. I've had a co-author on the show, Jay Papasan. That's a brilliant book. Hal Elrod's Miracle Morning, just had him on again. He's got a second version of that. How you set your day off right to propel yourself towards success through several things you do every morning. There's a few.
That's great. Thanks. Anybody? Ryan, Joe?
Yeah, I've got three recommendations. These are probably a little bit leaning more towards the specifics of paper assets, derivatives, and stocks. However, the principles apply across all asset classes. So, number one would be Safe Haven Investing by Mark Spitznagel. He runs the Universa Fund, which is a little bit more well known. Nassim Taleb helped found that. And it's all about asymmetric trading and hedging your downside risk. Another one would be all of the Market Wizard books by Jack Schwager. There's like 5 of them
Good.
now, I think. And in his original one, he's interviewing people like Ray Dalio in the beginning, when he's getting his start. And so just fantastic bits of wisdom and insight from the best traders and investors in recent history in those books. You find that all of them have the exact same number one rule, which is don't lose money.
Right.
And
Good
then let's see, the third one is You Can Be a Stock Market Genius by Joel Greenblatt.
Greenblatt. Yeah, that's a good one
Yes,
too.
Greenblatt. Yeah, that book inspired Michael Burry to get into the investing game, which obviously he had some success afterwards as well. So those 3 books are the top 3 for me.
Awesome. Thank you, Ryan.
I'll take a different tract here for those looking to build their businesses and build teams. I'll go with Multipliers as my first one. Love the book Multipliers, especially when you're getting into leadership and you're thinking about how to lead teams and how to grow your employees and really get the most out of your organization. And our whole theme this year inside of Spartan is the great game of business. That's a book, really fantastic author, Jack Stack, who takes you through the importance of getting everybody onto the same page in your organization, which is the P&L. That's what drives everything, right? So you can have all these KPIs, leading, lagging indicators, all these things that you do, but like if everybody's not onto the P&L, that's the real scorecard that really matters. And so we're taking all of our employees through financial education, special training, reading balance sheets, income, cash flow statements, all this stuff. And we're gamifying the things that we do within the organization that focus on driving financial results. So I think that's a really big one. And then one I'll kind of throw out, a book we mailed to all 1,100 of our investors this year was the Peter Attia book, Outlive.
Love that book too. Yeah.
Yeah. I figured you, Bronson, you probably
that's a
read
good
that
one.
times. Yeah. So, yeah, going to have him featured in our magazine, this upcoming edition. And he, obviously, there's different ways that healthcare has evolved, but really preventative and getting ahead of things is what it's all about. So that's really been resting on my mind lately after reading that book, is just all the things that you can do to kind of take care of yourself and avoid the 4 horsemen. So
that's great.
Yeah.
Who wrote Multipliers?
Multipliers was gonna catch me off guard here. Multipliers. No, you're good. Liz Wiseman.
Wiseman. Okay, I've got a whole list. I'm a big reader, so 98 books last year, working on more this year, and I encourage you. Leaders are readers. So anybody who's watching this wants to grow, just start reading books. And there's a quote: you'll be the same 5 years from now, except for the books you read and the people that you meet. So it's the networking and the educations. There's a lot of mindset in there. There's a lot of information. We are getting a few questions. I want to get to a few of these questions, so we'll kind of go rapid fire with these. Please put some more questions in if you do have questions. What metro markets are most vulnerable to the negative effect of zero or negative rent growth of new multifamily deliverables?
I don't want to go political, but I avoid blue states. I'm just telling you. I mean, there's a population decline. I mean, again, I'm definitely on the other side politically, but that's not why I'm saying that. It's You know, they're high taxation, they're broke, they're going to continue to tax, they're overregulated, they're going to continue to overregulate. So those are my definite no's. But you know, you've got to pay attention to you know, market demographics. And if you want to write down some websites, you go to city-data.com. You can go to bestplaces.net, datausa.io. Those are websites where you can look at demographical information. You want to make sure three things are growing up: population, income, and jobs. What's the most important? Jobs. And you know, can I mention my boot camp? I've got
Please, yeah.
Yeah, okay. I've got a virtual boot camp coming up April 6th and 7th. It's 2 days. If you DM me on any social channel, you can come for $97, and I don't sell anything there. So if you go to rodslinks.com, rods plural, links plural.com, just go to the boot camp site, but DM me and I'll give you a code. You can come for $97. But yeah, I mean, and we're going to go through all of this, you know, how to evaluate a market, what to look for in a market, you know, how to actually do the little bit of, and even if you're going to invest passively, why would you give your hard-earned freaking money to somebody without having a basic understanding of it? Come spend a couple days with me. I don't sell anything. For $97, be the best $100 you ever spent if you're going to invest in multifamily, for sure. So there's my
awesome. Thank you.
And
Yeah.
storage, we're apolitical because we don't have rent control laws.
I love it.
So
Probably some of the
it.
business friendly stuff probably matters a
yeah.
little bit though too.
Not really.
Not really. Okay.
No, you don't pay
Okay.
3 days, you're locked out. You don't pay in 30, we kick you out. So the government cares about tenants. They don't care about grandma's dresser. So we just go to wherever the good markets are.
Just fly under the radar. That's awesome. That's awesome. Okay, so developer question. Unless this one, we'll just kind of stick to Ryan for this one. Unless you guys have thoughts as well for the developers. The biggest piece of advice to new developers: what would you do differently? Actually, I know Rod, you developed some stuff as well, but Ryan, do you have any thoughts on that one?
No, not really. Not
really. Okay.
I mean, you got to break every parcel you buy into 3 pieces, right? You're a matter of right. So if you're going to buy vacant land, there's really 3 major risks. I mean, there's a lot of risks, but there's the 3 major ones. And I'll touch on a 4th, but number 1, you got to have matter of right before you buy the dirt, or you're just gambling at that point. Because if matter of right is like, is it zoned for storage? Is it zoned for does it have the zoning? Does it have the matter of right to do what you want to do? And that's the first risk. Second risk is, do you have a site plan approval or do you have it entitled, right? Because just because it's zoned storage or mobile home park or whatever the heck, it doesn't mean you can actually do what you want to do. You got to have site plan approval and entitlement. So that's the second risk. The third risk is a lot less, it kind of really comes off, which is building permit approval. Building permit approval is usually just the International Building Code, and you're just black and white sort of checking boxes. The only I got you there is what the fire marshal can say in Appendix X, which is going to be fire marshal can say whatever the hell they want, and you've got to do it. So when you're a new developer, you've got to make sure you're matter of right, you're entitled, and you're building permitted. And those are the 3 major risk factors. So if you're getting into it, if you can swing it, make your purchase and sales agreement so that you have all government approvals before you have to buy the land, and throw a few extensions in there, because you're going to need all the time that you'd ever think you'd need. And the last thing about development that will save your bacon is learn everything you can about title insurance. So your title company is not your friend. They're just going to get your rubber stamp title policy and get you closed. And you think, oh, title is just making sure that I'm the right. No, it's not. There's a lot that goes into title insurance. Like if you get a good survey, a good utility locate on the site, if you find something and it's an exception to your title insurance policy, guess what? It's your problem. So you can get a really strong title insurance that can protect you from all kinds of stuff that happens during the development. So, I would say those 3 fundamental things, but plus just making sure you've got title insurance down pat.
Got it. Thank you.
Good
That's
stuff.
great. Last question I'm seeing here, and then we'll get to kind of how people can get in touch and follow you guys. Do any of you view the upcoming Bitcoin halving as a viable situation to invest in? If so, what percentage are you willing to risk? I'd love to hear your thoughts on this, Joe.
I've always, since October of 2020, I've maintained that a 5% allocation to Bitcoin is a great starting point. If you do more, basically you're saying with Bitcoin, there's a binary outcome. It either becomes the universal new gold standard of money everywhere by all nations and every people, or it goes to 0. it's monetary technology. Money is a winner take all game. Those are the only two options. So 5% into something that has a high likelihood of going to zero means that worst case scenario, you're left with 95% of your portfolio. Best case scenario, if the unlikely scenario where it does become money everywhere does happen, then it, quadruples your portfolio. So I always say start off with 5%. If you want a dollar cost average in after that, that's great as well. But 5% and don't sell. I would not try and time the halving. A lot of these things are priced in. There's volatility around them. You're going to try and time it. You're probably going to do it wrong. You're going to end up paying more over the long term.
Got it. Okay, thank you. Any just real quick, 30 seconds. Maybe anything you want to add to Bitcoin conversation?
I can't even sell Bitcoin.
Okay, got it. The real asset guys are like, just let me talk about real assets. Okay, guys. Well, we'll be sending out a replay. That is correct. You'll get it via email. Also, if you haven't followed our YouTube channel, just under Bronson Hill, you'll find all these videos every month for the last 4 years. We've been doing great panels like this, and we've had each of these guys on at least one panel before. We put together unique panels. We bring in people from different things, and just amazing what happens when you get into different panels. So hopefully this was a helpful conversation for everybody watching. For those watching on a replay, thank you for watching. If you guys want to take 30 seconds, just real quick, if people want to follow what you're doing, just maybe give it a little pitch and say this is what I'm working on, or is how you can follow me. Let's start with Ryan, and then we'll kind of work our way around.
Yeah, so Spartan-investors.com is our website. My email is ryan@spartan-investors.com. We're buying storage, and we'd like you to join us. That's what I got.
Awesome. Thanks, Ryan. So good to have you, man.
Yeah.
Rod.
Yeah, go to rodslinks.com. There's all sorts of free resources there, books on the business. I mean, literally a dozen books, and some of them are best in class and they're free. My podcast is there. If you're interested in multifamily, it's the largest in the world. We're at 20 million downloads. So somebody likes it. So, you can subscribe there to the podcast. My boot camp site is there. If you want to join me for a 2-day virtual boot camp, DM me. You come for 97. It's more than that now, but yeah, thanks for participating, and I hope you take action with what you learn.
Awesome. Thanks, Rod. Great to have you. Joe.
Yeah, the best place to find me is going to be on YouTube. My channel is Heresy Financial. Heresy is an old religious word that means an opinion at odds with what is generally accepted. So Heresy Financial on YouTube, put a video out every week, about 250,000 subscribers. So if you want any more, there's lots there, lots more there.
Awesome. I just put a link in for my all my links there with my book and resources and free stuff as well. So, gentlemen, really appreciate each of you for being here. This was a lot of fun. And again, the replay will go out. So reach out to all these guys. I have a lot of respect for each of them in their various arenas. And again, we'll do it again soon. But thank you, Rod, Ryan, Joe,
Ryan,
all
Joe,
of our
pleasure to meet you guys.
attendees.
Yeah, likewise.
Always great to do this. And we'll look forward to having everybody on a future panel.
Take care, guys.
Thank you.
Thanks, guys.
See you, Joe.